I think it's on the system that created it and enabled that. If we were to do the same thing with our children, where every time they got into a pickle, every time they got into trouble, or if we always just paid our kids anytime that they needed money, what's going to happen to their work ethic? What's going to happen when they need something next time? They're going to come to us. They're not going to work for it. They're not going to go out there and find creative ways to solve it themselves. They're going to, and if we don't give it to them, they're going to complain. They're going to be that kid, on the bottom of the floor in the darn store that's kicking and screaming, yelling for their parent to buy them that candy bar because they bought it the last 5 times they kicked and yelled and screamed. And that's exactly what's happening right now in America.
What's up, y'all? Welcome to the Carrot Cast. Now, the Carrot Cast, we're usually diving in doing interviews with amazing real estate investors, amazing real estate agents. Now, in these episodes, every Thursday, they're the Trevor Truck Talks, where you get to hear behind the scenes of the mindset shifts I'm going through as a CEO of one of the fastest growing companies in America, and the mindset shifts you can take to run your business and win back your freedom as well. Let's dive into this episode.
Okay, y'all. I think it was a month or so ago, I recorded a podcast about kind of how to prepare for a recession. And I think we're probably officially in recession. I was reading something the other day, y'all, where a very smart person showed some indicators and some data and said that we're 3 weeks into the recession. Now, you're going to also hear from other people that we're not in one yet. You're going to be hearing from people that we've been in it for 6 months. And at the end of the day, I think it's hard to argue that we're not either in the start of the recession or we're very, very near to it. And guys, if anyone says that we're not going to be going into one, you have to also remember and think about trends. And in this podcast episode, I'm going to be talking about on my drive home the next 10, 15 minutes. I'm going to be talking about the trends that I see. I'm going to be talking about what I'm going to be looking out for, how I'm kind of thinking about what to do with my next moves. In the previous episode, if you haven't checked that one out, I talk about how to protect yourself when the market changes and when it's going to make an adjustment. So check that one out first, because you got to, number one, protect yourself. And then number two, what I talk about in there is be ready for opportunity, but you can't be ready for opportunity if you're not protecting yourself first. So go check out that episode. We'll link it up in the show notes on protecting yourself heading into and being ready for a recession. I want to talk about the opportunity side of it. How do we capture opportunity? Well, first of all, this isn't legal advice, not financial advice. Don't take anything I say in this podcast episode for gospel, because I've made predictions that were untrue in the past, as did 34 out of the 35 economists that work for the Fed, who said that this was not, a recession, or this was not inflation that was going to last. 34 out of 5 economists with the Fed said that they didn't feel that the inflation was going to last when it started a while ago, which is insane. To me, as you start to dig into that, guys, I was calling it well over a year ago. A lot of other very smart people, way smarter than I, were calling it well over a year ago, that inflation was inevitable. This is not what's called transitory inflation. Transitory inflation is where inflation goes up for a very short amount of time during a transition, then it goes back. This is not that, I don't feel, and we're already starting to see that. We've got inflation here for probably at least the next year to year and a half, I feel. Okay, and so what you're seeing is the Fed increase interest rates. They made one of the largest increase of interest rates in recent history of 75 basis points, so 0.75% essentially, just recently. And they're likely going to keep going up. I think the interest rates are going to be up over 8%, likely, for sure over 7%, I feel, by the end of the summer. And I wouldn't doubt it. I'm not going to call it, but I think that we have a very, very good chance for interest rates to be over 10% within 18 months. Now, what does that do to the economy? Well, the reason that the Fed has that tool to combat inflation is because when you tighten up the money supply, when you make it harder to borrow money, and money's a little bit more expensive, less people borrow money, which means there's less spending. When there's less spending, it means there's less demand for the goods and services that are being created. And when there's less demand for goods and services that are being created, it means the prices tend to go down over time. They tend to. They don't always, but they tend to. Okay. And so that's kind of the play that the Fed has. And when the economy is slow or sluggish and inflation is really, really low, they actually don't want inflation at 0%. They don't want what's called deflation, where it goes backwards. They want a good, what they call a healthy inflation of the 2 to 3% range. But once it gets up over 5, 6, 7, 8, 9%, like it is now, they say that that's not healthy because it puts pressure on the citizens, on the economy, and they stop printing money, right? So let's go all the way back to what caused this. Okay, so number one, we were at the tail end of a bull market in stocks, tail end of a bull market in the entire economy in real estate. And usually these market cycles run 8 to 12 years. Now, the last real crash, the last real reset was caused, of course, by a lot of very, very shady, unscrupulous, not good practices around loans in 2004 through 2002, 2003, actually, through about 2007. Those loans started to hit defaults in a big way as people's automatic adjustable rate mortgages started to adjust. There were three-year adjustments, 3-year arms, 5-year arms. Once those arms started to adjust and people were having a tough time with their jobs and the economy changed and all of a sudden interest rates go up, they couldn't refinance. They start to default on their mortgages. They're having a difficult time with jobs. And then all of a sudden everything crumbles, right? When those loan products go away, no one can refinance out. People get their credit destroyed. And then all of a sudden it takes people, somewhere around 5, 6, 7 years to get your credit back. And so a lot of those people who had their credit destroyed during that time, they got their credit back around 2014, 2015, 2017. Credit started to get easier again. We started to print a little bit more money during that time to get the economy cranking in that time. They called it quantitative easing, QE, at that time. And during the Obama years, they were doing quantitative or qualitative, whatever it's called, easing, to put more money into the economy. And when they're putting more money into the economy, they're creating demand because more money is around. People have more opportunity to spend. Inflation and the value of the dollar starts to go down at that point. Now, that was fine and things didn't hyperinflate until COVID hit, right? And so COVID hit and things hyperinflated because the government shut things down. People weren't working. People wanted to pay. People needed to pay jobs. The government didn't want people to have that hardship. Now, for real reasons, because they want to take care of their people, but also because of political reasons, right? Because we need to make sure that we're not the ones who are not saving our people, when they're struggling. The problem is, I think they went way too overboard. When Trump was in, I think they put in a little over $1 trillion in stimulus. And that $1 trillion, like 1.2 trillion or something, you can look up the exact number. That $1 trillion was in some sort of stimulus for business, which I think was a good thing because businesses are going to go out there and spend the money and put it back in the economy. Stimulus for workers who are out of work, which I think for many people was a good thing. I think for many people it wasn't a good thing. But in general, the stimulus probably did what it was supposed to do. But the only way you can create stimulus, y'all, is America's broke. Like it's beyond broke. So where does the money come from? It's not, the money they didn't have the money. Okay, they didn't have $1 trillion sitting in a bank account somewhere saying, hey, we're gonna do this. No, what do? They go to the Fed, and the way that they actually create that is the Fed prints the money. Or they don't actually print it. They click a couple buttons and say, magically now we have more money in the money supply. It's bits and bytes. It's fake money. They start sending this fake money to banks, sending this fake money out to people by direct deposits into their bank accounts. And then all of a sudden they have these bits and bytes that did not exist a week before. Then now this magical money appeared. Now, what happens when magical money appears, guys? When it's not actually based off of anything other than someone saying, hey, we have the ability to quote unquote print more and we're going to do so. Well, what happens is it devalues every other dollar that exists, including those dollars. So if, in example, if there's $15 trillion in quote unquote cash or monetary supply in the economy, then there's $15 trillion. Now, if $4 trillion gets printed out or $5 trillion gets printed out in a period of a year, like was pretty much what happened during the COVID years, after the initial stimulus with Trump, the next administration comes in, they double down on it and they put another 3 to 5 trillion. Check all the real numbers, guys. Not giving you real numbers. They're round numbers. But it was around the $3 to $4 trillion extra in stimulus and other packages and other things like that. A lot of it, I feel, was completely wasted. A lot of it was keeping people who should be working actually not working. It exacerbated the financial system, exacerbated the work system, exacerbated people getting their businesses going again, exacerbated the supply chain, which made inflation start to go up even more. right? And so there's two things that happen is they quote unquote print off more money supply, which devalues every other dollar, which is inflation. Okay. And here's the deal. If you print off $4 trillion, it's not the $4 trillion that's the issue. It's when that $4 trillion starts to get spent. If I get $5,000 in stimulus cash from the government, quote unquote free money, right? I go spend the $5,000 at 25 different locations. Those 25 different locations have this fake money now, essentially, and they go out there and spend it. And then the people that they spend it with go out there and spend it. And so that $5,000 that I got actually turns into somewhere around $25, $30, $40, $100,000 in spending power over that next 1 to 3 years, because it gets spent, respent, spent, respent. It's money that was not in the supply before. And so that $4 trillion the stimulus cash got put into the economy, it's not $4 trillion bucks. It ends up being 25 trillion, 40 trillion, 100 trillion, whatever the number is, because it gets spent and circulated and spent and circulated. And that takes some time. Okay. So as the money's hitting the accounts, everyone's saying, oh my gosh, the stock market's doing great. Crypto's crushing it. Gold popped around that time as well. Everything is great, right? But everything is great as well for the druggie who shoots up. And as soon as that druggie shoots up in their arm, they have this euphoria. This euphoria does not last forever. That drug is not healthy. That stimulus cash was a drug that was artificially propping up to show a quote unquote healthy economy. Just like a drug artificially props up someone's mood, artificially props up someone's happiness, and then it eventually stops. When it stops, things stop hard, and then the person is dependent on that. And so all this fake cash gets put out in the market, and people started to get dependent on this supply of cash that was getting sent their way. So what happens is that politicians want to stay in business. They feel, oh shoot, we can't now not continue to give money and resources to people. We need to double down on it. So you're starting to see more of these things happening right now in Congress and Senate, where they're trying to pass things to continue and even make permanent certain subsidies to people. So they are going to continue to get those. And I truly feel it's a political play. I don't think it's long-term better for those individuals. I don't think it's long-term better for the economy, for the government. I don't think it's long-term better for America for that to happen. People need to be able to stand on their own 2 feet. There are a certain amount of people, I feel, who truly, truly need help. And for those people, we need to help them as a unified America. We need to help the people who truly actually need help. But so many of the people who are getting the help, guys, don't need it. What they need is a swift kick in the pants and some motivation, and they need to have their back against the wall. So they have to go out there and create. They have to go out there and add value to the world. But there's so many people who unfortunately grew up in an environment where they learned it. They're multiple generations in and having this mindset, which is unfortunate. I'd love to be able to work with people in that way to help break people that cycle. And I don't want to cast blame on those people. I think it's on the system that created it and enabled that. If we were to do the same thing with our children, where every time they got into a pickle, every time they got into trouble, or if we always just paid our kids anytime that they needed money, what's going to happen to their work ethic? What's going to happen when they need something next time? They're going to come to us. They're not going to work for it. They're not going to go out there and find creative ways to solve it themselves. And if we don't give it to them, they're going to complain. They're going to be that kid, on the bottom of the floor in the darn store that's kicking and screaming, yelling for their parent to buy them that candy bar because they bought it the last 5 times they kicked and yelled and screamed. And that's exactly what's happening right now in America. There's enough people who have gotten enough things by kicking and screaming and yelling, and then enough people who are in power who don't want to be out of power and who are essentially just bowing down to those who are kicking, yelling, and screaming. And they're giving them more of what they actually don't need, what I think is actually going to destroy their lives, their families, this economy in America faster. And so what do we do with all this? Well, once that money started getting spent, it started to drive up inflation. Once people were getting, this artificial stimulus and they didn't have to go to work anymore, that drove up inflation because the supply chain got hit, because now there's not as many people out there to build the things that are needed with all this extra demand because of this extra money. The same thing happened in the real estate market. People have extra money. The loans were insanely cheap, right? There weren't enough people to go out there and build the houses. So supply was down and exacerbated home prices. So as people are looking at this, they're going, well, shoot, does this mean the home prices in America are going to go down? I actually think home prices in a lot of places are still going to go up this next 12 to 18 months. I was watching a CNN news story literally this other day, and they were talking about, it was David Green from Bigger Pockets was on there, and they're sharing examples of 3 different markets. And they were saying, and David was saying, hey, we think these 3 markets, there's a lot of markets that are actually going to increase. Roseburg, Oregon, guys. It was like literally Dallas, Texas, like Knoxville, Tennessee, and Roseburg, Oregon were the 3 example markets that they shared, showing 20+% predicted house price increase over the next 12 months. Now, is that accurate? I don't know. I don't think it's going to be too far off. But because the interest rates are going up, it doesn't mean that home values are going to go down, which is a good thing short term, right? But also, it's a supply issue. We need to get more people working. We need to get the supply built up. But eventually, the supply will have equilibrium. When it does, prices will soften. And that's amazing for all of the investors out there, especially those using creative finance. So finding opportunity in this market ahead, guys, those of you who focus on creative finance are going to win. Those of you who know how to solve problems in a way that's different from the rest of people are going to win. Okay, those real estate agents who hyper-focus on a niche and get amazingly close at that niche are going to win. Those real estate investors who hyper-focus and turn into hybrids, and agents turn into hybrids, who hyper-focus on learning creative finance and helping sellers as things get a little bit more difficult in some of the market in the next 3 to 5 years are going to win. A couple other opportunities. So people look at it and go, well, shoot, should I be investing in crypto or should I be investing in gold? Well, I've been researching the heck out of that as well. And there will be opportunities that are going to pop up. But what usually happens when interest rates are going up, and this is kind of a good little tip for those of you to know, hey, do I invest in gold or not? Gold probably is not going to be going up while interest rates are going to continue to climb. Because what people look at, the big institutional buyers especially, is they say, is there a better spot to put my money that is going to keep up with inflation well? And as interest rates go up, to kind of curb inflation, like I mentioned before, a lot of people then will put their big chunks of money in an interest-bearing, type of investment, like a bond potentially, or something else, because then it is a better safe store of that value. They think, as long as they think that the currency is going to continue to be strong. Now, the one cool thing that I have seen with gold, though, during this time period is, while you've seen crypto completely crash, and people have been talking about crypto being a store of value. They feel that's a store of value that's stronger than gold. Because realistically, crypto, until it really becomes widely adopted, is not a useful thing. Like, I can't buy crypto and do something with it, right? I can buy a piece of real estate and do something with it. I can't buy crypto and do something with it. Crypto by itself does not do anything. I can buy a stock in a business, and the business actually creates value into the world by creating a product and a service. The same thing with gold. Like, I could buy a room full of gold and it functionally doesn't do anything. It just sits there. But because gold has historically been the default hard currency in the world, it is still used as the hard currency, that when soft currencies or the fiat currencies like the dollar or other things like that, when those start to go down, people will still go back to gold because it's been the time-tested currency for thousands of years. And so what happens when interest rates are going up, gold prices are likely not going to go up anytime soon. They're actually going down a little bit. But the cool thing is, while crypto crashed, gold has maintained a relative stable value. And so I am putting some more money into gold because I do feel that our currency will have a really hard time over the next decade. And I think buying some gold while it's going down is going to be very important. I think gold will be up over $2,000 an ounce within the next 36 months, and we'll see. They've been calling that for the last 5 years, and it got up above it briefly, then went back down. But I'm going to be buying a little bit more gold. Probably add $50,000 to $100,000 in gold to my to my portfolio rather than just the cash sitting in the bank. And I'm going to be finding some other ways to redeploy some of my cash into interest-bearing accounts. There's this one place called Marcus, I think it's just Marcus.com. It's Goldman Sachs. They have a high-yield, high-interest savings account, which that's not like a good investment, but I'm earning, I think it's a 1.5 or 1.75 interest on a hunk of money that's sitting over there, rather than it earning like 0.25% in my traditional bank account. So if you have a chunk of money that is just going to sit there and you're using it to kind of store up for capturing opportunity, but you still want it to be liquid, move a bunch of money over to Marcus.com, and you're going to be able to at least yield some better interest over there on a high yield interest account, a high yield savings account. So while I'm stocking up some cash and then getting a little bit of hedge with gold, I'm going to be looking for opportunities in multifamily. I'm going to be looking for opportunities for investments in businesses businesses to pop up, because I think some businesses are going to be really struggling over the next 3 to 5 years where they didn't manage their cash well. And we just acquired a company in January, really, really good company, InvestorFuse, amazing CRM. We're making the product even better. We're getting Carrot customers like Tyler Ford moved over to InvestorFuse, closed the deal within his first 3 weeks from the InvestorFuse follow-up that was put in place, the automated follow-up. And but the reason I'm bringing that up is that business wasn't managed well from a financial standpoint. And so we were able to come in, get a good value in the business, invest into it with none of our own money because we're able to get a good bank loan, owner carry for a good hunk of it. And now we're investing into the company to help it grow. And I'm going to look for other opportunities like that. So if you're a real estate investor or an agent, I'd really, really encourage you to stock up as much cash as you can, get some of that cash that's just sitting there into high yield savings accounts. I'm not a big guy on stocks. I just don't understand them well. So I've got a little bit in my 401k, mainly for a tax thing. But I'm going to be looking for more opportunities to invest in a multifamily. The past 6 months or so, or past year or so, I've invested into about 400 units of multifamily. Now, by me saying invested into, I own a very, very small percentage of those units. One building I own 10% of that building. Another building I own 3%. So it's a good way to diversify across multiple buildings. But one of the buildings is a $16 million apartment building in Texas. And so I'm going to find more of those opportunities because as inflation goes up, I'm going to continue to still see residential real estate being in demand. And I think that rents are still going to be really, really strong. And so guys, look for opportunities in multifamily, look for opportunities in rental real estate in good, stable areas. Look for opportunities to buy businesses at a discount over the next 3 to 5 years and do it with creative finance. If they're overburdened with debt, how do you step in and take over a good business that just ran badly from the finance standpoint and make it amazing? I think there's going to be more wealth built in this next 3 to 8 years, 3 to 5 years than probably people have built in this last 5 years. Or a lot of people think that your wealth is built when markets go up. No, you can get rich. You can get rich when markets are going up. You get wealthy when markets are struggling. And that's when discounts are had. And then you catch the next market upswing. So guys, look out for those opportunities. Okay, so I'm going to wrap this podcast episode. The last one, once again, in this series was talking about how to protect yourself during a recession. What do you need to do to prepare for it? This one here is talking about opportunity. What do you need to look for to capture opportunity? Okay, and so I'll give a quick review. Number one, you got to understand the economy, understand how money flows, understand what's happening in the macro economy so you can take some confident moves. Number two, make sure you're storing up some cash. That came from the last episode on preserving and protecting. Make sure you're storing up some cash, okay? That way you are ready when opportunity is there. Get some of your money moving over into some of that like reserve cash, moving over into a high yield savings account like Marcus.com. That's where I moved a good hunk of money over there. Just so it's liquid, but I'm earning a better interest rate versus just sitting in my normal bank account. And then look for discounted businesses and discounted real estate and opportunities in residential real estate, guys. And I'm going to be talking about more of these opportunities I'm capturing and really looking at how we can use this to our advantage and also use it to our clients' advantages. We want to see you guys grow. We want to see you guys add to the community. We want to see you guys beautify the community, not just look at this as an opportunity to take advantage of situations, but to be prepared for situations where other people are maybe in a tough situation where you can help them out in a way that helps them and helps you. Guys, I'm going to be talking more about this at the $1 Million Meeting event in Dallas, Texas, end of August 31st, September 1st, 2022. If you're listening to this before then, go to milliondollarmeeting.co/carrot. That's milliondollarmeeting.co/carrot. There's going to be some of our most successful Carrot customers there at the event. Guys, I'm going to be insanely pumped to be there myself. And guys, go there, grab a ticket. VIP tickets are almost sold out. We're going to see you guys there. I want to meet every single one of you guys and gals in person. And you're going to get a chance to meet guys like Keith Stanton, Bo Hollis, and the home buying guys, and Cody Hoffine, and so many other amazing Carrot clients, plus about 70 or so Investor Fuel members, Mike Hambright, so many others, guys. So milliondollarmeeting.co/carrot. I will see you there. Let's get ready for this market shift and win together.